Welcome back everyone. Today on the day 2 of our course, we are moving from what and why of the marine cargo insurance to its foundational how. We are diving deep into the fundamental principles that form the absolute bedrock of all the marine cargo insurance contracts. Think of these not just as rules, but as the essential legal and ethical pillars that govern the entire insurance relationship. Understanding these principles is paramount because they directly dictate how your policy operates, how claims are handled, and more importantly, the ultimate validity and the strength of your cargo's protection. Without a firm grasp of these core tenets, navigating the complexities of marine insurance can be challenging and you might inadvertently compromise your coverage. Our goal today is twofold. First, to clearly define and help you grasp concepts like utmost good faith, insurable interest, and proximity cost. We'll demystify that these terms mean in practical terms. Secondly, and crucially, you will understand precisely how these principles directly impact the validity of your policy and the success of any potential claims. This knowledge empowers you to ensure your insurance contracts are robust, your disclosures are accurate, and that you are well equipped to manage the claims process effectively, ensuring your valuable cargo truly remains protected against unforeseen events. Our first principle is utmost good faith. This is a cornerstone of all insurance. It simply means that both you, as the person getting in the insurance, and the insurance company must be completely honest and transparent with each other. You need to tell the insurer all the important facts about your cargo and the journey. This includes anything that might make the risk higher or lower, like the type of the goods, how they are packed, or if you had claims before. In return, the insurer must also be honest about the policy terms. If either side does not disclose all the important information or misrepresents it, the policy can actually become invalid. For instance, if you don't mention that your cargo is dangerous, or if you hide a history of frequent claims, the insurance company might not have to pay out if a loss occurs. Next up is insurable interest, a principle that forms a cornerstone of all the insurance. Simply put, you can only insure something if you have a genuine legal or financial stake in it. This means your financial well being must be directly connected to the safety and the successful journey of the cargo. If the goods arrive safely, you stand to benefit financially, perhaps by completing a sale or using them in your business. Conversely, if those goods are lost or damaged during the transit, you would suffer a direct financial loss. Without this direct connection of your potential gain or loss, you lack the fundamental right to insure. This principle ensures that insurance policies are taken out only by those who are genuinely affected by the outcome of the cargo's journey. A crucial aspect of the insurable interest, especially in global trade, where ownership can shift, is that you must possess this financial interest at the exact moment the loss or damage occurs. While you might arrange the policy beforehand, your financial stake must be present at the time of incident for a claim to be valid. For example, if you own the goods outright, you clearly have an insurable interest. However, even if you have already sold the goods, but your sales contract stipulates that you remain financially responsible for their safe journey, you still maintain the insurable interest until that responsibility ceases. This flexible timing acknowledges the complex nature of international transactions and ensures appropriate coverage for all parties at risk. Let's talk about our third key principle, indemnity. This is super important for understanding what insurance is all about. Simply put, when you have marine cargo insurance, its main job is to put you back in the same financial spot you were in just before your goods got lost or damaged. Think of it like this. If your wallet goes missing, the goal of the insurance is not to give you a brand new or bigger wallet with more money, but to replace what you lost so you are not out of pocket. It's about making you whole again, not making you richer from something going wrong. Because of this, insurance is not designed for you to make a profit from a loss. That would defeat the whole purpose and could lead to problems. So, any money you get from a claim will always be limited to the actual financial loss you suffered. You won't get more than what your cargo was truly worth or more than the maximum amount you insured it for. If your cargo was valued at $10,000 and it's completely lost, the insurance company will pay you that $10,000 after any agreed amount deductible, which is a small amount you pay first. It's really about fair compensation. The idea is to cover your real loss so you don't face a huge financial hit, allowing your business to recover smoothly. When something goes wrong and your cargo gets damaged or lost, it's not always a single clear cut event. Often there's a chain of things that happen one after another. For insurance purposes, we need to figure out the main, most effective, and the direct reason that ultimately lead to the problem. This is not necessarily that very last thing that occurred is about tracing back to the dominant cause that set everything else in motion. For instance, if a big storm hits your ship and because of that seawater gets into the cargo hold and ruins your goods, the storm is considered the proximate of the damage. The insurance company will then look at your policy to see if damage caused by a storm is covered. It's not enough just say the cargo got wet. We need to understand the primary event that led to water damage to determine if the loss is claimable under your marine cargo insurance. Let's move on to our fifth important principle, that is subrogation. This might, this might sound a bit technical, but it's actually a very fair and logical rule in insurance, especially in marine cargo, where many different companies or individuals can be involved in moving your goods. What it means is simple. Once your insurance company has paid you for a valid loss covered by your policy, they then essentially step into your shoes. This gives them the legal right to chase after any other company or person who was actually responsible for causing that loss. This principle serves into two main purposes. First, it prevents you, the insured, from getting paid twice for the same loss, once by your insurer and then again by the party who caused the loss. Insurance is about compensating your loss, not allowing you to make the profit. Second, the equally important, subrogation makes sure that the party who was genuinely at fault for the damage ultimately bears the cost. It promotes accountability within the supply chain. For example, imagine your valuable goods are damaged because the shipping company used faulty equipment or a truck driver working for them was reckless. Your insurance company will first pay you for your loss, so you are not left out of pocket. But after they pay you, they gain the right to legally pursue the shipping company to recover the money they paid out. They effectively take over your right to claim against the negligent party. This ensures that the true wrongdoer is held responsible, and it helps keep insurance premiums fair for everyone by recouping losses from the responsible parties. Alright, let's wrap up our principles with the last one, that is contribution. This principle becomes important in some specific scenario. When the exact same cargo facing the exact same risk is accidentally covered by more than one insurance policy. It's not common, but it can happen. Perhaps if different parties involved in the shipment, like a seller and a buyer, both take out policies without realizing the overlap. When this rare situation occurs and a loss happens, the principle of contribution kicks in. What happens then is that all the insurance companies involved won't each pay out the full amount of the loss. Instead, they will share the cost of the claim proportionally. This means they will divide the payout among themselves based on how much coverage each policy provided. For instance, if you have two policies, one for $10,000 and another for $5,000, covering the same $10,000 cargo that's completely lost, they won't each pay $10,000. Instead, they will work together and you will receive a total amount of $10,000 for your loss, with each insurer paying their fair share according to their policy limits. Just like with the principle of indemnity, the main reason of contribution is to prevent you from making a profit from a loss. You can't claim the full amount from every single policy you might have from the same cargo. These principles ensure fairness and that your actual loss is covered once, but not overcompensated by distributing the financial burden appropriately among all relevant insurers. That concludes our deep dive into the fundamental principles of marine insurance. So, we have covered the essential rules that govern how insurance works, from utmost good faith, insolvent interest, indemnity, proximate cause, subrogation, or contribution. These principles are the absolute foundation, ensuring that all the insurance contracts are fair, transparent, and effective in protecting your cargo. I'd love to get your thoughts out of the pulse principles we discussed today. Which one do you believe is the most crucial for maintaining fairness in insurance and why? Please share your thoughts in the comments below. Looking ahead to join us for the day 3 where we will explore Incoterms, another vital concept for understanding responsibilities in global trade, building directly on what we have learned about cargo protection. Thank you.